Hello everyone, this is Robert Fross from Fross and Fross Wealth, SII Investments with our July 2012 monthly video update. And during the next few minutes, we're going to talk about some of the key drivers behind this month's stock market and economic performance. Please listen at the end for a required disclosure statement. So July, another very volatile month in the equity markets. We saw the markets knocked around by some disappointing U.S. Economic indicators and continued bad news and this crisis that Europe is dealing with. Even so, despite all the volatility, the market still managed to close slightly positive for the month. The S&P 500 tacked on 1.26%, the Dow was up 1%, and the Nasdaq gained 0.15% for the month. Now, July also saw some important economic news and major international developments. So let's discuss how they affected market movements during the month. So during the final weeks of July, we saw the releases of corporate earnings reports for many major companies. And really across the board, most companies showed weak revenues, with less than half exceeding revenue expectations. Thankfully, however, although they missed revenue expectations, many companies were still able to beat earnings expectations, which simply means that these companies are getting better at doing more with less. So these disappointing revenue results show that the sluggish economy is affecting businesses and unfortunately could have an effect on the employment picture, which is the last thing we need. The question it really begs us to ask is this: if businesses weren't hiring before, will they be hiring now? Now, the employment data all over the month in July really heavily affected by seasonal factors. Now, although we're not able to draw too many conclusions from the data, one potentially positive indicator that we saw was an increase in the hiring of temporary workers. And typically when we see an increase in temporary work hiring, it typically leads to an increase in full-time employment. So as you can see, all factors considered, the employment picture really remains uncertain. Housing sector, that was really a bright spot in an otherwise turbulent month. Housing starts, those were up for the 5th straight quarter. Total number of new homes under construction rose for the 10th straight month in June, meaning that the housing sector still has some room to grow as buyers are taking advantage of really all-time historically low interest rates. Now let's move on to what everybody's concerned about, and that is concerns in Europe. Ongoing concerns about Europe really underpin much of the market turbulence we saw last month. The market's responding strongly to both negative and positive news from Europe. We can probably expect that trend to continue. The Euro mess appears to be accelerating towards a resolution, however. Important developments occurring on a daily basis. We've got Greece, unfortunately, back on the ropes again. They will probably need more debt restructuring. The cost of that is going to have to fall on their European neighbors. Spain, if you recall, they had applied for a bank bailout in June. They're very likely going to need a full bailout, as many of its provinces are asking for federal help meeting their debt obligations. Major rating agencies, they've now stepped in. They've responded to all of this by downgrading the Spanish and Italian debt. They've also issued warnings to core nations like Germany and Holland that a bailout could threaten their economic solvency. So in simplest terms, we've got Greece, Spain, and now Italy. All of them are struggling under their existing debt load. And although the European Central Bank promises solutions, we're just not sure that there's enough money existing in the Euro system for everyone to get a bailout. We're keeping a close eye, however, on European developments going forward, as we really need those leaders to start making some serious choices about the future of the Euro. Now let's get back domestically. Federal Reserve, they went into the whatever it takes mode in July. They outlined the various options that they have available to themselves in the event the economy needs another jolt of economic easing. The options that the Fed is considering include purchasing more treasuries, purchasing more mortgage-backed securities, or directly lending to the banks to increase their liquidity. Now the FOMC, or the Federal Open Market Committee, they meet the first week of August, and although we can hope for more quantitative easing, most analysts just don't believe the Fed will take action this month, but rather they think that the Fed's probably going to use this month as an opportunity to discuss strategies going forward. Looking ahead, we think that either a full decline, future decline in the jobs market, or an increase in deflation risk will force the Fed to act. Hey, thanks a lot for listening to our stock market and economic recap of July. We look forward to seeing you again in September as we recap what happened in the stock market and the economy in August. Thank you. Take care.